Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll go through the market update. Nothing really going on with earnings right now. It's pretty much over. And then, Joe's going to go through, he's got some charts to show you. Next week we have a team meeting, so we're not going to do this call next week because Joe's coming into town. We got pretty much 2 days of meetings, so we're going to skip next week's meeting. However, I will still put out all the earnings stuff, and I'll send an email out on probably next Tuesday. Or Wednesday morning to let you know. Just remind you, we're not going to do the meeting next week, but all the next earnings plan iteration will be posted then. So, all right, let's get started. So surprisingly, not a lot of changes here. SPX is still in 6. The weird state. Russell's still in 1, and NASDAQ been holding in state 5 for quite a while. So we'll go through those charts individually. Green pie wise, not a significant drop. We had 43 bullish, now we're down to 39. So very minimal change, over that week, which is a little surprising. So let's take a look at market pulse. So last week, we were right at the cross. So, it did cross, kind of like a momentum thing. Just a matter of, is it going to continue? Are we going to get longer runs? So, I wanted to pull up. So like the state 7s or the, 7, if it's a bearish state, environment, 7 will go to 8. But we're only at, we only got 4% in state 7 right now. So the majority of them are in, 5, you got 9%, and then state 1s. So for a lot of these, the transition, to get more 8s, they'd be coming from 6. 4s are pretty low, but the 7s aren't really gonna, those are pretty much flatlined. So this kind of a thought there. Things to watch. It's hard to, it seems like the 7's a bottom, but hard to say, which way we're going. Obviously, we did get to cross, so just a matter of, is it going to be a long run, or not? So one thing, though, a couple other things. Obviously, nothing going on here. Pretty much for this year on the highs and lows. So, just we'll glance at it, but nothing meaningful coming out of there. On this 200-day moving average chart, you can see we're getting pretty close to a cross back over. And, if you pull it back, the last bearish cross we had this November of 2021, and we just had a very long run until basically beginning of this year. So if we get another crossover, obviously it's going to be a bear sign overall. So just keep we'll keep monitoring it, but getting pretty close here. So that's pretty much it on that chart. Bullish, bearish. So we did get, been a couple weeks since a cross. So really what you want to look for is kind of like a topping pattern here, over an extended time where, it's basically, topping out. So haven't really seen it yet. We had a little dip and then kind of run back. So, this would, this kind of action can give us an indication that a reversal is possible. Not always going to happen, but you can see up here, pretty much topped out. right around here, and then eventually it's going to turn over. So sometimes they're shorter, sometimes they're longer, but yeah, we look for a nice sustained kind of top, and then see things start turning, then we can get a little ahead of the market. So yep, that's it for market pulse. Excuse me. SPX state 6, obviously just like a strange state, strange chart in general. I mean, we entered at 39.70. I think we're like right almost back to where we started in that state. I think the kind of key thing is probability wise, we're 70% going to state 8. Now that doesn't mean market tanks. It just means we're in 8. There's a higher possibility of the market tanking in 8 than anywhere else. So still isn't transitioned. Been double the days. So dip below, kind of got into the stops. It's just a very tight range. Can't really draw much from that. Bigger chart. Let's pull it in here. Like my range, the 42. All right. So it's 42 is the top. Sorry if these aren't perfectly. And there's your 38. So, long. So, almost a year, kind of in May will be a year, kind of in this range with a couple bumps out. And we're right in the middle of the range, 4,000. So, that 4,200 divided, the short-term top, the 38 was very good support at the end of the year, kind of took off from there just straight up. And then, so, still in the range pretty much. Let me clear this. If you look at, we're kind of also right in between so that's the top line is the 50. So it's pretty much right at 4,000. So we're dipped right below that. And then the 200's 39.40. So very tight range. We had this crossover, and typically you like to see, let me just annotate here. Typically after this is the golden cross, the 50 going above the 200. Typically, you like a nice run up, and then this 50-day acts as strong support. Right now we're pretty much we retested, which isn't bad. As long as we bounce off of that, and then the key I think would be to see the 50 acting as support on the way up. That's a very bullish condition. If we get like that 50 providing support. So where we are currently, we did get about support off that 200, which is positive. We're above, we got above 50. We're right below it right now. So we would like to see that act as support and stay above that 50. That'd be very bullish. So this bounce is the bullish thing. The state going to probably 8 is the bearish thing, so kind of conflicting. And big picture, we're smack dab in our range of 42 to 38. So that's SPX. Kind of a boring show, the past week or two, if you ask me. So let's move on to the Russell, still in 1. So the 1 has held, and I would just attribute that to the 1900 holding down here, this kind of 1900 level. So we're currently below it, but as long as, I guess, as long as it's holding, it'll stay in state 1, but it's not looking like it's going to be in there much longer. Especially if SPX goes to 8, then I would definitely think Russell's going at least 2. That's where it normally goes after 1. So been in there about half the normal time, but just been really playing along the stop loss. When it comes down the stop loss, we like within a few days for it to like roar back up. Obviously, very bullish sign. You had a little run up here, but immediate reversal back down. So, it's just kind of same old tune on the Russell 1900 is the key level. And we're just bouncing up and down above that and below it, since last week. So let me pull up the lines here. So this is that 1900. And we're trying. So, but it's been, and then there's 17. So the next level up would be that 2100. Obviously, if we stay above 19. So that's kind of, where we are with that. If you look in closer, like I said with SPX, I mean, you want to stay above that 50. We're right below it. It's the 50s that, just, call it 1890. So right below 1900. So, it's just a critical level of that 1900. So keep harping on it. And, that's really the thing to watch. So, if it does continue lower, you want to see that support on that 200-day, 1826. So, I mean, this is obviously a good sign back here, the golden cross, but if it starts to fail, it could easily turn back over. So, and we can use the states to help guide us. So, all right, I was just going to pull up NDX kind of real quick. That one's in 5. I mean, these things are all over the friggin' map. You got a 1, you have 5, and a 6. Market's very confused, if you ask me, on which way things are going. So, I mean, this was a, great target 3. I mean, you can see it pretty much touched that and then come back, basically right back at the center, where it started. And, that's why we like take some profits at target 3, especially if, it reverses. So, came up the next day, touched it again, but that was it. So those are, just kind of reemphasize these levels, provide great support resistance levels. If you just kind of go the T3 entry price and stop loss area. So those are kind of like your key ones. Let's call it 2 for support and resistance. So in this great example right here of that. So, okay.
Hey, Josh.
Yep.
Just one quick thing, and I know we didn't talk about this, but you point out that NDX got to target 3, and not for now that we have to go check it, but it just strikes me. I wonder if in the last 14 months NDX got to any target 3, being that it was the weakest index out there. So just something maybe I'll take a peek at. But yeah, the fact that NDX got to a target 3 is pretty shocking.
Yeah, especially, I mean, you can see here, like the 1-year chart, the highest it's been is a 5. In this last 5 in August 2022 was, a couple days was the top, and then it turned over. And, other than that, in the last year, it's been 7, 8, 7, 8, you get a 6, and 2 5s. So in this 5 is, trash. This one, we had kind of similar thing. We had 2 days up, and then, it's just kind of meandering. This one obviously turned over, but, you got a good run the first 2 days, and that was it. So, still, I mean, a very bearish chart overall. Can't get out of 5. There's your last state 1.
Yep.
Back there in 2021. So it's been quite a long time. And not the the true death spiral, this is the 8-7-8-7, but then it popped out. So it's a mini death spiral.
Well,
So,
also that one state 5 you point out in August came out of the absolute lowest level from a state standpoint, overall in terms
mhm,
of the green red pie, which was mid-June. So,
mhm,
basically that was, the tide lifts all boats into that state 5.
right.
And, one thing, and sorry to interrupt you, but just one
No, no,
thing that came out of just doing a little bit of homework and maybe part of the reason, NDX bears watching here is out of the December lows, not the October lows, but, the December 22nd or 28th lows, NASDAQ, and basically I think because it had been, so decimated last year, it by far has been the market leader. I mean, running into that early February rally, February 2nd, that darn index was up over 20%, where, Russell was 16 and SPX only 11. So, I'll talk more about it when, I pull up a chart or two, but
yeah.
just the fact that it got to a target 3 is very, very interesting to me.
Mhm. Yeah. And I mean, from here, you get 60-something% chance going to 1. So, yeah, just kind of the same old story. I mean, you got SPX saying going to 8, this one saying going to 1, and Russell
Right.
Russell in 1. It's like what? Just kind of,
Sounds like a trading range.
This
yeah,
is this is
yeah,
Dave. Can I make a comment on Joe's comment there?
yeah.
I was I was thinking along some of the same lines that you were just thinking there, Joe, but the making target 3 happening while interest rates were on the rise. I think the just recent fact that we hit that was the maybe misbelief that interest rates would stop rising now, and if that reaching 3 required that thinking, I think, by market participants, the sentiment of market participants, I think. And if it isn't, when it isn't, then if they're, as long as interest rates are not about to hit the top yet, I think that's going to prohibit hitting target 3s for the NASDAQ, until then. I don't, that's my opinion on that. I think it has a lot to do with what the expectations out maybe 6 months are with respect to interest rates affects how bullish, especially the NASDAQ can get, because it's the companies in the NASDAQ, I think, are the most sensitive to interest rates. So when the all clear signal is given, that's when you can get your target 3s or go above. But when there's some disbelief in that, I think it keeps that from happening. What Josh just said, what it happened last time in 20 and in 21.
Right.
Well, that was when there was before all they started hiking interest rates, or just about that time when they started hiking interest rates. That's when target 3 became unattainable by the NASDAQ. From the sentiment point of view, that's what my mind thinks and feels anyway. It's a feeling thing, not a logic thing. Yeah. Anyway.
Well, certainly the interest rate perceptions have changed an awful lot. We had a couple different lows in the market. You had the June lows from a pie perspective and really historical lows in June. And then you had really the September 30th, October 13th lows for the broad market. And it was kind of after that period that this perception of rates, obviously, Dave, has changed. But just even in the face of that, the fact that we could get to a target 3 is to me pretty interesting. I think part of it, again, is because it was so crushed last year. By far, it was the only index. If we go back to the March 2020 lows, the COVID lows, NDX was the only index that exceeded the 618 retracement by a long shot. So, yeah, well, we'll see. It'd be hard. I get something else when it's my turn that I'll pull up that kind of surprised me a little bit too.
Thanks, Joe.
Welcome.
Hey, can I, this is Lee. Can I jump in here?
Sure.
Come on, Lee.
Okay,
Go ahead.
so this question's for everybody. And there are two parts. And talking about interest rates are up, and what is the effect on the economy as I see it right now? In one big place is on commercial real estate. And these people that have a lot of commercial real estate, they're not happy signing new leases right now because interest rates are so high. So there are some defaults going on there. The second thing is with earnings that are coming up. As interest rates go up, it's going to eat into the profits. And so earnings, I expect to not be as good as they have been in the past. Now, how do you all see the effects of these increased interest rates on the businesses, the free cash flow, whatever you want to equate it to? And what does that mean for the market as we go into the next 6 months, let's say? And Dave, I'll pull that number from you because I think it's a pretty good number there. Well, what's going to happen? We talk about everything, and we do a great job. Josh, you do a great job as we talk about what has happened. But how do we see it from this point going forward? I'm very interested in your comments and your thoughts. So, Josh, and
Yeah.
Dave, and Joe, Pushpa, anybody.
Yeah, Lee, my initial thought is like it's going to affect, different companies different, right? So if a company has already like is forward thinking and they've already locked in, long-term loans at, super low rates, then, they don't really care, right? I mean, they have all the capital they need. Now, a company that uses like revolving credit or, frequently using credit, the cost of capital is going to go up for them. So just, it costs more, the loans are going to cost more on a monthly, quarterly, or whatever, they're paying off basis. So that's just, kind of the general thing. And then, if people are out there, real estate wise, I mean, obviously, the costs go up significantly because, prices haven't dropped that much, some of them have, but, the same loan, at 3%, now it's at, God knows, like 7 or something. I mean, the monthly payment's like a hell of a lot more. So that's going to drive down transactions, and people are going to, either, pay all cash type thing, if they have cash, or, people are just going to not, just wait, because they can't afford it. Right. So it's just,
Right.
it's just going to affect, some companies that are well, forward thinking, and, they got cash and they don't need, they took out all these loans, or, they don't need to take loans, and they're not going to be affected as much. Doesn't bother them. So,
Right.
but other ones are going to get, going to have real problems,
And I'd agree with everything you said. And now I'm extrapolating some of that flowing into earnings, where their earnings won't be as strong if you're having difficulty because of the price to borrow money.
Mhm.
Yeah,
Right.
this is Dave. Can I throw 2 cents behind what Josh was saying? With the comment that it really affects different industry groups differently, different indexes differently, and different companies differently, right? If it's a single company that you're thinking about, you probably need to look at how much debt they have and that sort of thing, their balance sheet, their more fundamental kind of things. I think I've heard more comments from different news outlets or whatever over the last 6 months to a year that, if you will, retail money has been flowing into companies that have balance sheets that are respectable, not a lot of debt, and can pass along all of the inflation costs that they see. For example, open a company or an industry group that's in more of a monopolistic position can afford to transfer all of their inflation back to the people that buy their stuff. So if you're invested, so that's one impact that's different depending upon what group or what individual stock you're looking at, right? So,
Yeah.
so going forward, I mean, that's pretty much what a lot of I think Ameritrade and Fidelity and just the different news groups have been saying. Well, people are focusing on companies that are actually making money, and the companies that aren't are the ones that have been punished for their lack of earnings. Getting back to how earnings are going to be impacted the most in an earnings call. If a company has debt, is a high growth company, but isn't showing any earnings yet, as a lot of the high growth companies are, especially in the NASDAQ. And those are the ones that got slammed on their earnings calls when they didn't show some other metric that justified their multiple that you described when you were talking, when we were mentioning multiples there. So, it's when I brought up the NASDAQ versus, the Russell and the other, my comment that I made before, I made that comment because, in my opinion, most of the companies that are in the NASDAQ are of the don't have dividends necessarily, have high PE ratios, and that's why I think they're more sensitive to the interest rate hikes, because the analysts have to bring down their future multiples. Whether they have or not is, how you play a company, how are you traded it up or down, or what your bias is when you're making a trade.
Yeah. I agree with everything you're saying, Dave.
Yeah.
And Lee, if I could chime in, I think there was a pretty strong consensus last week on the call about a trading range moving forward. And I think that's the crux of your question, where we headed. I think we will, maintain the trading range. And I think maybe the transition of various states, may give us a hint as to where leadership or weakness may come from. But I think, and I'll pull something up later that I pull up once in a while, the Yardeni earnings estimates, they are still rock solid, suggesting that earnings for 2024 will be slight, and 23 will be slightly higher than what we had in 22. That's both the Yardeni as well as the consensus estimate, and 24 higher than that. So I think we're in a trading range with pockets of strength and weakness inside of that range.
Interesting. Okay, good. Well, thank you for your comments, everybody.
Yep, no, good questions. All right, let's continue on. We're 2 weeks out, so we've got the countdown up there to the Fed meeting. So you can see there has been a big shift. So last week we're 70% for a quarter hike, and now we're almost 80 for a 50. So huge swing based off of Fed talking head Feds, what's been coming out of them. So so look at a 50. I mean, then you can, if it's pretty much going to be a 50, so that's 5%. You can look out, obviously we didn't, before have anything above 5 really at the end of the year, but that's all changed. So big changes overall, so, and this only goes a month back. So, but you can see here, like a month back, this was pretty much high rate, and, we went through this a lot before, but now, 550, almost 6 kind of range. So big changes in that. Just had to keep an eye on the inflation. So I thought it was all coming down, it'll pop up. So we'll just have to keep our eye on it. Um, balance sheet, slow moving, nothing newsworthy here, just kind of a slow mover. Overall, we kind of look at 7,500 being kind of a okay. Get a little leery once it gets down there. Is that the proportion it fell when we had problems last time. So just saying, that would be where I would start to get concerned. Something might happen. I did want to pull up this one. The 2 and 10 just keeps getting worse. So we're over 1%. I want to pull up, because we pulled this up a while back. So this was from, sorry, we pulled this up in August, right? When this thing first started. You can see it's 38, 37 back then. And now we're over 1 as far as the inversion. So what does that mean? Here's the inversion chart long term. And, we're pretty much, let me get the little tool here. This is pretty much the last time we were that low. And then, nothing else really came close. I mean, here, here was nothing. So we're back, I guess they said like 1980-ish time frame was last, this obviously got lower, you can see down here. But we're over 1 and kind of in this range here. So it's been a long time, and obviously inflation was a huge problem back then. I was only tyke, so I don't remember it, but just want to point that out. Obviously it's getting uglier, as far as this 210 recession predictor, that people say. So I mean, you look at the chart and it seems pretty good, at predicting things. So that's kind of the, when they keep saying they're going higher for longer, no cuts this year. So I don't know, we'll see how this thing pans out, but just wanted to pull up those charts based off of, this thing just getting worse. So the inversion. So that's it. All right, I'll open up to, you guys already peppered questions, but any other questions or comments? We had a pretty good spike here in rates recently. So past month, a pretty good spike, and trying to get over 4. That 3-5 range is really kind of like the line in the sand. Like back here, it's like anytime got below, kind of popped up above. So and now it's just a matter of the 52-week high is 4.333. So I don't know if we'll make a run at that, but very volatile overall, this whole treasury, unusual. So, but I guess in the environment we're at, no one knows which way we're going, and the Fed just grinding higher on these rates. So I don't think we have any data coming out, inflation wise until next week. We just have the employment on Friday. So, all right, any last chance before Joe takes over? All right, okay, you ready, Joe?
Yeah, Josh, I'll grab the screen. All right.
Yep.
Let's see. I don't think. Hold on. Let's try that again. There we go. All right. So one of the things that got me, I mentioned, the moves coming out of the December lows. What got me thinking about that was, we were talking retracement numbers last week from both the October and December lows. And as it turns out, SPX traded right to that number, the 382 of the December low and the 382 of, the December low and the 618, or no, the other way around. 618 of the December low, 382 of the October low at 39.28. Right to the low on the second, and then rallied from it. Russell and NDX didn't get close to their numbers. I'm like, oh, and again, I'm always trying to think about where is their leadership, where's it coming from? So, the numbers I mentioned earlier, NDX up 21% since the December lows, Russell 16%, and SPX really trailing at just over 11% coming out of the December lows. And again, back to earnings, there's no appreciable change. Here's the Yardini estimates, that I pull up from time to time. You can see for 2022, basically, 215, the fourth quarter, they're still trying to finalize the numbers there. As I mentioned, a little bit higher in 23 and much higher in 24. That left column is Yardini, the right column is a consensus. And I'm not sure exactly how many he's got for the consensus, but I think it's a number of economists. So, that seems to be pretty steady. So I'm just pulling up a couple of the charts again. There's Russell, 1875. We've tested 3 times, since, the earlier low here. So I think short term, an 1875 hold. It's not that big a deal because we've got it, on a retracement basis, just out of the December lows, you can go all the way down to 1831 and still, not be breaking anything. There are no it's really just a choppy ABC kind of market. I think it was Russ who asked about, the counts last week. SPX, really, just kind of the same thing, although it clearly has been the softest of the 3 indexes. And there's NDX, which, you look at NDX and it, holding up pretty well after a pretty good run out of that October. I think it was 10,660 low, somewhere in that neck of the woods. Yeah. So, trading range. But then getting into the weeds a little bit. And, we went through the, different groups last week. And so I'm going to try to keep track of that a little more closely. Last week, we talked about 7 of these things being in bearish states, and I think 4 in bullish, and that hasn't changed. But what has changed is the number of state 1s and state 8s. And a little bit to your point, Lee, where are we going? I think the fact that we've gone from 1 state 1 and 1 state 8, it's 3 8s and 2 1s kind of speaks to the confusion of the market just over the last week. So industrials, Josh does a hell of a job, talking targets, stop losses, and, future direction. But, the industrials, as we know, we talked about it last week, they've been in a 1 for a long, long time. But look at that range. I mean, it's just, it's long, it's tight, and it'll be interesting to see, where we go forward. That's obviously been leadership. Next, we've got the technology. State 1, last 4 days. That's what really caught my eye this week. Okay, so this thing has now rolled into state 1 after the NASDAQ had a big run out of the December lows. So, last week I was talking about keeping an eye on the discretionaries. Now, bang, I'm watching this thing to see if we can get, any sense of, leadership coming out of here. I mean, you look at that chart, that's a darn healthy chart, coming out of those September, October lows, higher lows throughout. I'm guessing if we can get through these recent highs, where are they? They're, the 145 range, something like that. I mean, we're still going to be in our trading range because, as Josh points out, we got a long way, to 4,200 in the SPX. But my guess is we'll have a healthy market if we can get through there. So to me, the technology XLK is the one to really keep an eye on now for, potential direction of the market going forward. Some of the stuff we talked about last week, XLP is, this is 6. No, this is 8. Okay, so this went into 8, right? This is one of the ones that transitioned into 8. So you talk about cross currents, we got one. So another one to watch, kind of, darn important. It's been, for the most part, lower lows, lower highs. So I think it's the battle between this and potentially technology going forward. Here's, real estate, which leads to your point with the commercials. Shook states are saying we got problems. We were 6, now we're 8. We'll see if 8 turns out to be any good. So that's another real important one to watch. What do we have here? Decent number of occurrences, over the last 15 years, 26 of them in 8. We're 4 days in, but interesting to me, only a 12-day average, in the real estate, bearish mode. Of course, real estate, coming outside of the financial crisis has been pretty positive, but, that's an important transition that I'll be watching over the next week as well. The last couple, I think, were just nothing really too new. We're bearish in the XLY, but it's a 6. And let's see, we've only had a couple of them, 6 occurrences, over 15 years. So I'm not sure exactly what that means, but it's slightly bearish. And then just the last one would be, the XLU rolled into, has been in 8, and, that doesn't surprise us, because of the interest rate environment. So they're the charts. I watch technology, watch real estate, and see what comes out of, the next week there. Josh pointed out we've got the jobs number on Friday. I think that can definitely be a market mover. Last month, we got the ridiculous number, whatever it was, 512. We were expecting 185. And I think that really fortified this new direction with rates, and the market, a month ago started to, obviously rates have been going up. One thing I was surprised by in looking at Friday's number, which again, they're expecting, I think, 210. In 2022, the average monthly gain in jobs was 400 grand. I did not, now I know we're coming out of COVID. I just had no idea it was that high a number. So, they're expecting 210 on Friday. We'll see what we get. November and December were revised up with last month's revision, revised up by 71 grand. So I think, revisions, are worthwhile to keep an eye on too. Sentiment, pop this up every once in a while, AAII, the bullish side has been shrinking, a little bit dramatically, and I'm sure that's, basically because of rates. And then just a couple things on the inflation front. I mean, we're still getting, pretty high inflation numbers, and yet, as we all know, gas has dropped pretty precipitously, about 50% from its low to its high. So that certainly has not been a headwind with inflation. Those headwinds seem to be coming out of the labor market, which is why I think Friday's number is so important. And then let's see, this is, different freight figures, and how crazy, and I guess this is North America to China and what it costs to, move some of the cargo. And it's back down to, where it was, pre-COVID. So again, certainly not a headwind for inflation. There have been some good things supporting inflation, but the labor market, seems to be maybe the biggest bugaboo there. Again, there are the earnings numbers, which have remained pretty consistent. So that's all I had for you this week, Josh. And certainly, any questions, comments, please.
Yep. No, it's
Yeah.
great, Joe. Thanks for running
Hey.
down. Go ahead.
I've got one question for Joe on the retracements that you were mentioning. So I'm trying to read between the lines or interpolate, like Lee was saying. So Joe, am I thinking that that maybe the SPX is reacting, let's say, more right on cue as to what the Fibonacci retracements might suggest than the other two indices? Is that what I gathered from what you were saying?
All I take away from it, Dave, is that the S&P 500 is the weakest of the three indexes right now. That's all I take away from it.
Oh, okay. I thought it was hitting the fib numbers more accurate, or the critical to retrace levels better than the other.
It got to, the fib numbers, the ratios are basically 3/8 half and 5/8,
Right.
3/8 to 0.5 and 6/18.
Right.
And coming out of the December lows, as I said, NASDAQ has rallied 21%. Russell 16%, SPX just 11%, and that really caught my eye. And then those fib numbers that we threw around last week, only the SPX, which clearly has been the weakest index out of December, October lows, got anywhere near the retracements that we were talking about last week. When you talk about the October to, what was it, February 2nd highs. So just, I won't say that it's acting necessarily better, only that the fib numbers are defining the SPX as clearly the weakest of the three indexes.
Okay. All right, thanks for that. And just a closing comment on my part, but I think if it's 2 weeks from now, we're having the next meeting. If you go through the sectors like you did last week, that'll be after the Fed meeting, and all the interest rate information will be out, talked about and digested. That might be the clearest view forward toward the next 6 months or whatever that I think we're going to get. So maybe you could touch on that the next time again. That might help a lot, I think, or everybody.
Be happy to do it. And just, for me, as we go through, the process of these meetings, I latch on to different things, both personally and then, what I think might be, beneficial to the group. And, over the last month, looking at the indexes, and then, the different segments, we're coming out of such a significant low in September and October. Trying to find market leadership, I think that's the place to find it. So that's why I'm concentrating on them a little bit.
Yeah, I agree. Thanks.
Yep.
All right. Anyone last chance here?
Hey, I got a quick one for Joe. Joe, talking about your Fibonacci and retracements, and at one time I think we went back and did a Fibonacci retracement against the pandemic back in February, March of 2020. And as I look at it now, you don't have it pulled up, but we're up above the 3.8, and it just seems, based on that stuff, on the Fibonacci's, that I'm guessing we could go lower, and it would be pretty strong, I think. Certainly looks like we could get back to what was it, October, and then maybe, is it September? Or October? Yeah, definitely. That would be down to 0.5
Thirty-
almost.
Yeah, 3,500. I think there's
Yeah.
a 3531 or something where no,
Yeah.
3491. Yeah, bingo. And I mean, so that's and you know, do you think that was a 3/8 retracement, or I think that might have been like a 50% retracement coming out of October? Actually,
Yeah,
I got
yeah.
to the money, Lee, because I just pulled up a sheet. You know, the low in 2020 was just below 2,200. All right, we rallied to 4162. 3505, if my math is correct, was 50% in the SPX. You know, we bottomed at 3491. Okay, and so we got the 0.5 there, but in the NDX, as I said earlier, we far exceeded the 618 retracement. You know, which was, anyway, I know we did. And NDX, the low was 10,660, I believe. And, you know, let's see, 10,000, that's Russell. And the 1641 in Russell, as Josh has been talking about for months, you know, we've tested over and over. Let me see, Russell 1641 was between 0.5 and 0.618. It was right in the middle of it because the 618 was 1535. We bottomed at 1641. Okay.
Yeah.
And see, NDX, and I hope I'm not boring everybody with just, you know, numbers here. Well, NDX, you know, we talked about. So run by me again your thinking on why, you know, we may get a significant sell-off based on the SPX retracements.
All right, thank you. I'm thinking with interest rates higher, it costs companies more to borrow. And I think we're in a position now where more and more companies are refinancing their debt. More companies are going back to their bank and saying, okay, I want to borrow. And the interest rates are significantly higher. And I think that's putting downward pressure on earnings. And, you know, home loans, they're, I think, just over 7%. So I think quite a few people are, let me say, there's a strong decline in the number of people that are taking percent, a few 3%. And then the whole earnings play as we go through the next earnings cycle, which starts in a couple of weeks, companies will report fewer earnings. And all of this, I feel, and we'll see, would put downward pressure on stock prices, and we could fall off and get down to the 618, maybe. That'd be pretty low. That'd be about 3,200, roughly.
Exactly.
Yep. Yeah, that would be a strong downward pressure, and I'm trying to get your interpretation of what you see, along with everybody else on the call, Josh and Dave and Mark. Anybody that wants to chip in. So that's what I'm thinking. That more and more companies are rolling into this higher cost of capital. It's affecting their business negatively. We all know that homes are the biggest driver of our economy, and then you got earnings affected by all of that. And the downward earnings, I think people could get a little nervous. And I didn't even bring up war and the rumors of war that I wanted to ask Josh to speak about, but I won't do it. We don't have the time. But there are a lot of uncomfortable things happening on the geopolitical front, if you were to ask me.
And Lee, I think I don't think you hit the nail on the head with the SPX at 3,200. That is the 5/8 retracement coming out of the October lows. So well done there. And I think what you just, that last thing you mentioned. If you get something geopolitical, I think that's what takes us to 3,200. I just think, and I'd be surprised if we can go to 3,200 with, you know, earnings dropping off that much. But I've also been reading where, you know, the market leads the earnings, you know, prognostications are kind of the last thing to happen. So far they haven't changed, but for now it's a trading range, and Josh, as he does every week, just defines these levels and ranges for us, you know, so well, and we have to get through those ranges first, obviously.
Right.
Yeah.
Thank you very much. Thank
Yeah,
you.
just real quick, I mean, obviously the whole war situation is not getting better. I mean, they're just like stepping it up like incrementally. It's like now they're gonna send fighter jets. So I don't know. It's not a good situation overall, but you know, my two big things that could drive it down are the liquidity event and the war. So that's what I've been saying for a long time. So nothing really popping up, but you know, the war thing it's just like a steady you know, steady build up. So I don't know if it's gonna when it would pop or anything like that. But you know, you want to see de-escalation, but it hasn't been like that at all. So anyway,
When you
that's
say
it.
look,
Hmm?
Josh, when you say a liquidity issue, you don't mean like back in late 2018 or early 2019. You mean, what do you mean? I just so I can follow.
Yeah, no, I was talking about like the 19 type liquidity event. I mean, you know, I pulled up that old uh chart about when the Fed raises rates. It's always some kind of like, you know, banking loan like crisis, like I don't know.
Right. Overnight rate.
Yeah, overnight rates, you know, crash, you know, bunch of saving loan crisis, like all that type of stuff, subprime debt. It's a debt issue. You know, you keep raising rates, you know, things can get out of control. So, you know, that 2019 was the overnight got crazy and they had to start pumping again. So just in general, something like that is what I mean.
Okay. Okay. Good. Thank you.
All right, we'll wrap it up. I appreciate everyone's time. You know, just a reminder, next week we will not meet, but I'll send out an email with all the earnings stuff, and the following week we'll cover that. So thank you all.
Thanks, Josh. Thanks, everybody.